Manish, hi, morning. Good to have you on the show. And, just looking at the kind of data, the FI participation which has come back, and we were looking at, the open interest when it comes to just the GIFT Nifty yesterday, and that's sitting at a dizzying height. It seems like the market is broadening even further, more participation coming in, and that kind of gives you the conviction that, the gains are here to stay pretty much.
I think after the rate cut in the US, there's an element of dollar carry trade also happening. In emerging markets, we have had some stimulus given by the Chinese government, and dollar index pretty much is sitting close to 100. And it has fallen from 105, 106 to something like where we are right now. There is a case of borrowing in dollars and investing in emerging markets, and you saw some very good buying by FIs in the month of August, late August, and I reckon that that would also be the case when we are looking into September. Of course, there will be bouts of volatility, but I think every decline will be bought into. This has been the stance for a very long time now. Is only going to be remaining the same. The market has become extremely diversified to paint in general that everything in the broader market is overvalued or everything in the larger cap index are not so overvalued. I don't think that's going to be the case. It's going to be individual stocks, it's going to be individual sectors. But my sense is that every dip will be bought into. There will be pockets of strength, there will be pockets of weakness. And we go through this, and the markets are going to only meander higher as we progress into time.
Absolutely, and it's going to get selective, I guess, like you rightly pointed out. But let's talk about, where there is some amount of valuation comfort, right? And that seems to be the underperforming private banking space. Of course, an Axis and ICICI Bank as well continue to hold up. But in particular about, an HDFC and Kotak, and you don't have to get into the individual names, but just trying to understand whether there is merit in looking at private banks, because, there have been many of false starts that we've seen in the past year.
So, as I said, that there is a problem of plenty, and when there's too much of funds and you're looking for valuation comfort, private sector banks, public sector banks do offer an island of comfort in terms of valuation. And we have to look into FY26 as opposed to FY25 because earnings are going to be that great in FY25, even as far as the private sector banks are concerned. Cost of funds have gone up. Credit cycle has remained benign for a very long time. Particularly the retail side of things are starting to look at uptick in our credit cycle. So you'll have some elevation of slippages come through, and that would translate into anywhere between 10 to 15% sort of an earnings growth. On a price to earnings multiple, some of these private banks look very comfortable, not so much on the basis of price to book, but essentially it has to do with the fact that valuations are extremely comfortable. And that is why when you have a lot of funds to deploy, this is one large area which can absorb a lot of capital, and at the same time, there's valuation comfort. So I think that's the play as far as the private sector banks is concerned. It's a large index play. But overall, I think it has remained underperformers for a very long time. But currently, because of valuation comfort, they're getting bought into.
Morning. What about the consumption sector in terms of earnings growth? That has been lagging for quite a few months. Do you see that picking up now?
So a lot depends on, let's say, the FMCG space has to do with how the monsoon plays out. Overall, again, there's not too much of valuation comfort as far as the FMCG names are concerned. Vis-a-vis the growth that these companies are offering, I think I'll be remaining selective on consumer discretionary names. Urban consumer is doing better than the rural consumer as far as the discretionary names are concerned. But I think if there is a good monsoon, you'll also look at discretionary names in the rural sector start to do well. So overall consumption is a good place to be in. but one has to be very selective. Can't be a general, one size fits all sort of an approach as far as the consumer name is concerned. But overall, barring a few, FMCG is not really the place to find value vis-a-vis the growth that these companies are offering. But discretionary, yes, a lot of positives are still to unfold as far as some of these names are concerned. But particularly the areas of the urban consumer, I think there's the maximum interest.
That's the latest coming in as far as consumption is concerned. Manish, hi, this is Anisha also joining in the conversation. What's the take on power? Because that continues to be one space wherein we have seen stock prices rise as much as 40 to 60% this year so far. There have been fresh capex announcements now. Do you expect this move to continue?
Yeah, absolutely. As far as the capital goods space is concerned, when you have to choose between, let's say, defense, railways, and power, I think both the PSUs, private sector, you'll have selective names where there's a lot of interest, and it's likely to continue because some of these power related names, particularly those in the public sector units, are offering decent amount of growth at very reasonable valuations. Some of the private sector counterparts are trading at very elevated valuations, particularly the value chain when you talk about cables, transformers, switch gears, conductors. These are offering some ridiculous valuations. I mean, these would be overall avoid, but some of the large private sector, public sector units, particularly the transmission, the generation side of things. Some of the names in the renewable space, wind, solar, they would be offering good growth, and the valuations that some of these companies are trading at. I would believe that this is one space which will have some decent upsides as far as the stock prices are concerned in the medium term, and they offer decent amount of valuation comfort as well, because India is short on energy security. It requires a lot of energy comfort when it comes to achieving a 6.5% real GDP growth. I mean, there's humongous amount of work that needs to be done in this space, and I think the entire value chain will gain, but one has to find where there is valuation comfort. Some of the generation companies, module companies, wind power, transmission, and I will reckon that even the public sector units have a good offer in terms of value.
And given the kind of activity and fervor we've been seeing in the primary markets, the IPOs that are expected, what are your thoughts, Manish, on some of the new IPOs?
I mean, that's the biggest risk. Too many big IPOs could choke the flows into the secondary market, and we have some very big-sized IPOs coming within the next 2 months. The Hyundai and the Swiggies of the world, they'll be taking a lot of capital out of the markets, primary markets. Of course, you'll have a lot of inflows as well. But SME is one space which is full of froth, total avoid. I would say 95% is an avoid. There will be few which has a value, but on an overall basis, even before listing, you have some astronomical gray market premiums, etc. I mean, it's a lot of froth and momentum out there. Mid caps, it's selective. Now, most of them you don't get allocations. The decent ones which are there. Large caps definitely something to look into, particularly the recent IPOs that we will see, particularly the decent IPOs that you're going to see in the space. You would have NSC also looking to come out with an IPO within the next few months. So large ones are where it gets a bit interesting, but mostly an avoid in the small cap space and the SME space, and very selective. But this could be a source of potential risk when it comes to flows. Too much of IPOs, too much of paper. In fact, hitting India because of the sheer up move in the markets could choke flows as far as the secondary markets is concerned. We need to watch out for this.
Sizable ones, both Hyundai as well as Swiggy. But Manish, to the point as to whether or not valuation should be a metrics also or not to try and judge some of these household names, if I can call them, Hyundai as well as Swiggy, Bouts. I mean, because, history has told you that there hasn't been a better time than the IPO if you got lucky and got allocations, because those levels don't ever come back. I mean, look at a trend, for instance, this morning. I mean, today you've got a brokerage putting the price targets at 92.50. I mean, before you know it, Trent is going to be a 10,000 rupees stock. So is valuation really a metric in this market that you should be looking at?
So valuation, Aisha, will always remain a metric to carefully analyze. And over the last 3 decades that I've been there in the Indian markets, I found out one thing is that you attribute PEG valuation metrics. If let's say some company is growing at 100% and the PE multiple is 100, the PEG is 1. As long as the PEG multiples on structural businesses is less than 3, you could have some scope of appreciation provided the growth remains there. But if you have some company or some industry broadly growing at 15-20% and you have a valuation multiple of 75-80, it's very difficult to sustain. And if the P multiples were to contract, you're going to lose money even if the company grows. And a 5 PEG multiple broadly in Indian markets for the medium to long term doesn't sustain. So some of these names which could be coming out for IPOs, of course, we have to analyze how they would be faring in terms of growth for the next 5 to 10 years, and then take a call whether the valuation, even let's say 2 years out, are conducive when it comes to making money in the next 2 to 3 years. Otherwise, everything is just momentum, and that's basically a lot of risk that you're dealing with. And I don't think it makes sense to really pile into something which is just sheer momentum, because it's bound to have pitfalls, and there could be a lot of time correction, price correction. Even though businesses are good, companies are good, managements are good, but I mean, there is no better thing than to really take a call on valuation when it comes to allocation plans capital. I mean, it's a must. And more than 3 price to earnings growth generally doesn't make you money in Indian markets, is what I found out. And if growth falters, looking at some serious price risk.
Extremely wise advice coming in from Manish Sonthalia. Great to chat with you as always. Don't be fancied and fooled by the momentum. Look at valuations always. That's where you find merit and you find some good opportunities as well.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.